In the last 24 hours, 4 massive events just hit the silver market. And together, they confirm something most people still don't understand. Silver is not behaving like a normal commodity anymore. It's moving like a strategic weapon. The biggest problem right now is simple. The silver market is no longer functioning the way people think it is. For decades, investors were taught that silver trades like any other commodity. Supply comes in, demand goes out, and the price reflects reality. But that system is breaking down in real time. What we are watching is a market that is split into 2 completely different worlds. On one side, you have the paper silver market. This is where prices are set through futures contracts, options trading, leverage, and bank-controlled exchanges like COMEX. Most of the volume happens digitally, with contracts that represent silver, not actual silver. On the other side, you have the physical silver market. This is where manufacturers, industrial buyers, defense contractors, and solar companies operate. These buyers don't want paper promises. They need real metal in their hands because silver is essential for advanced technology, energy infrastructure, and national security. And here's the dangerous part. These 2 markets are no longer agreeing on price. The paper market might say silver is worth one number on a screen, but physical buyers are paying premiums far above that just to secure supply. That tells you the true market price is already higher than the official benchmark. This disconnect matters because silver is not just an investment asset anymore. It is a strategic resource. It is used in every solar panel, every semiconductor, every modern weapon system, and every critical supply chain the world depends on. And unlike paper contracts, silver cannot be printed. The recent historic crash in silver didn't fix anything. It didn't create new supply. It didn't solve the multi-year deficit. It didn't refill exchange inventories. All it did was temporarily scare buyers and delay the inevitable pressure building underneath the surface. COMEX inventories remain thin. Industrial demand continues rising. Governments are now stepping in. And miners are quietly confirming that the real price of silver is not what financial media reports. That is why this moment is so important. Because when physical reality finally forces the paper system to catch up, the repricing will not be small or gradual. It will be sudden, violent, and historic. Most people won't realize what's happening until silver has already moved beyond reach. Now here's where things get serious, because what just happened in the last 24 hours is not normal market behavior. In fact, these 4 events together may be the most bullish setup for silver we've seen in years, and almost nobody in the mainstream financial world is connecting the dots. First, the United States government just confirmed that it is developing a price floor system for critical minerals, and silver is part of that conversation. Think about what that means. A price floor is the government openly admitting the current market price is too low and unstable, and that they are preparing to enforce a minimum level through policy. That is not free market trading. That is strategic intervention. Second, the largest silver producer in North America just released its full-year earnings report. And hidden inside those numbers was a shocking detail. They sold their silver at nearly a 30% premium above the official market price. That is not a small difference. That is industrial buyers paying extra to bypass the paper exchanges and secure real metal directly from the source. Third, the CEO of the biggest online precious metals dealer in America published a rare letter to customers. Why? Because for an entire month, the physical silver market was so overwhelmed that shipping delays became the norm. Demand exploded, inventory tightened, and even the largest dealer in the country struggled to keep up. That is a clear sign the physical market is under pressure in a way most investors don't understand. And fourth, there are currently tens of thousands of silver call options sitting in the money heading into the next major expiration window. Even after banks slammed silver nearly 46% in one of the most violent crashes in decades, these options survived. That creates a dangerous situation for the shorts, because if even a fraction of those call holders decide to exercise and demand delivery, the pressure on COMEX inventories could become impossible to contain. So when you combine all 4, a government-backed floor, industrial buy physical shortages breaking dealer infrastructure, and options positioning threatening delivery stress, you get one conclusion. The paper-silver market is losing control, and the physical market is starting to take over. This is not just another rally. This is a structural shift. And the next move could be the biggest one yet. Let's start with the biggest development first, because this one changes the entire game for silver. Yesterday, Bloomberg reported something that should have been front-page news everywhere. The United States government is actively building a critical minerals price floor system, and it is already being discussed with allied nations. This is not speculation. This is not a rumor floating around the internet. Senior U.S. officials have confirmed that multiple government agencies are involved, and conversations are already happening behind closed doors with key partner countries. Now stop for a second and think about what a price floor actually means. A price floor is the government stepping in and saying this mineral will not be allowed to fall below a certain value. That is not normal free market behavior. That is strategic economic policy. And silver is not being treated like a luxury metal anymore. It is being treated like a weapon of national importance. Vice President J.D. Vance recently stood in front of representatives from more than 50 countries at a critical minerals ministerial meeting and made it clear the U.S. plans to establish reference prices at every stage of production, enforced through adjustable tariffs. Translation? The U.S. is preparing to guarantee minimum pricing for minerals that are essential for national security and industrial survival. That is an admission that the market is broken. Because if the free market were functioning properly, governments would not need to create floors, reserves, and strategic pricing mechanisms. But they are doing it now because the world has entered a new era, supply chain warfare. China dominates refining and processing. China has already begun restricting exports of key materials. The West is responding by building protective systems to ensure supply and stabilize prices. And when governments start treating silver as strategic, prices do not stay cheap for long. Now here's where it gets even more interesting. On the exact same day this price floor story surfaced, Hecla Mining, the largest silver producer in North America, released its full year earnings report. And what they revealed is one of the most important confirmations we've had so far. Their financial results were extraordinary. Revenue surged, net income exploded, and they posted the strongest performance in the company's 135-year history. But the real story was not profit. The real story was price. The average benchmark price of silver in the fourth quarter was around $54 per ounce. But Hecla's realized silver price? Over $69 per ounce. That is nearly a 30% premium above the so-called market price. And that raises the obvious question, how does a mining company sell silver for 30% more than the official COMEX benchmark? There are only one or two explanations. Either they perfectly timed the market, holding back production until prices spiked, or more realistically, industrial buyers are bypassing the exchanges entirely and going directly to the mines, paying premiums just to lock in guaranteed physical supply. And we already know this is happening. Samsung has signed deals to secure entire mine outputs. Physical lease rates have spiked because institutions are desperate to borrow real metal. Shanghai has been trading physical silver at huge premiums compared to paper pricing. Now Hecla confirms it from the supply side. The real price of silver is higher than the screen. The paper price is not the true price. The true price is whatever an industrial buyer is willing to pay when they actually need metal to keep factories running. And this is where the market begins to fracture, because paper contracts can be created endlessly, but physical silver cannot. Now look at what Hecla did next, because this is one of the most bullish signals in the entire mining industry. They are selling gold assets to go all in on silver. Let that sink in. Gold is near record highs, and Hecla is choosing silver over gold. That tells you insiders believe silver has far more upside ahead. Their production guidance for next year is rising. Exploration spending is increasing. They are positioning for a future where silver becomes even more valuable and even more critical. And their cost structure makes it obvious why. Their all-in sustaining costs are around $18 per ounce. They are selling silver near $69. That is an enormous margin. In some operations, byproduct credits are so strong that their cash costs are effectively negative, meaning they are getting paid to mine silver. That is not normal. That is what happens when a market begins to reprice around scarcity. Now let's shift from miners to dealers, because the demand side is sending the same message. The CEO of APMEX, the largest online precious metals dealer in the United States, published a rare letter to customers. He announced that shipping times were finally returning to normal after weeks of delays. At first, that sounds like good news. But the fact that this letter even exists tells you something deeper. The physical silver market broke. For nearly a month, even the largest dealer in America could not keep up with demand. Orders surged, inventory disappeared, shipping timelines extended, customer service was overwhelmed, weekend order volumes were reportedly multiple times higher than normal. APMEX reduced product selection just to manage supply. This is not what happens in a calm market. This is what happens when physical demand overwhelms the system. And here's the key question. Did supply suddenly improve? Or did the massive crash temporarily scare buyers away, reducing demand just long enough for dealers to catch up? The answer is obvious. The structural shortage never disappeared. It was only paused. So what happens when prices begin rising again? The shortages return, the premiums return, the delays return, because the underlying deficit remains. And now we come to the fourth piece, the one that connects everything directly to the next major moment in the futures market. There are currently tens of thousands of silver call options sitting in the money heading into March expiration. Even after banks smashed silver nearly 46% in one of the most violent drops in modern history, these call positions survived. That crash was supposed to wipe them out. It failed. Now, every dollar silver recovers pushes even more calls back into profit. And here asks why that matters. Each full. If even a fraction of these call holders exercise their contracts and stand for delivery, they are demanding physical silver from COMEX. But COMEX registered inventories are nowhere near sufficient to cover full delivery demand. The math doesn't work. Most traders close contracts for cash, but this time is different because industrial buyers actually want the metal. And when physical silver trades at huge premiums, the incentive to take delivery becomes stronger than at any point in modern history. So when you connect all these dots, government-backed price floors, industrial buyers paying premiums directly to mines, dealers overwhelmed by physical demand, and massive options, positioning, threatening delivery stress, you get one conclusion: the paper silver market is losing control. And the physical market is beginning to dictate reality. This is not just another cycle. This is a structural shift. And the next move could be historic. So what does all of this actually reveal? It reveals that silver is no longer trading like a normal metal, the beginning of a structural reset, a moment where the paper market is losing control and the physical market is taking over. For decades, silver has been priced through contracts, futures, and financial instruments that represent silver, not actual silver. The world has been operating inside an illusion where the price is determined by paper volume instead of real supply. But now, that illusion is breaking. The first and most important signal is the US government stepping in with a critical minerals price floor system. Think about how unprecedented that is. A government does not build a price floor unless it believes the market price is dangerously wrong. A floor is an admission that silver is too cheap, too unstable, and too strategically important to leave entirely in the hands of financial exchanges. This is not just economic policy. This is resource warfare. Silver is essential to military systems, renewable energy infrastructure, semiconductors, and advanced technology. When governments start treating silver like a strategic asset, the price can no longer remain suppressed forever. The second revelation is what Hecla's earnings report confirmed. The largest silver miner in North America sold silver at nearly a 30% premium above the benchmark market price. That is one of the clearest proofs that the official paper price is not the real price, because the real price of silver is what industrial buyers are willing to pay when they actually need metal. And industrial buyers are bypassing the exchanges. They are going directly to mines. They are locking up supply. They are paying premiums. That is not normal behavior in a healthy market. That is the behavior of buyers who don't trust the paper system to deliver. Then comes the third signal, the physical breakdown at the dealer level. APMEX, the largest precious metals dealer in the United States, could not ship orders normally for weeks. Demand overwhelmed the infrastructure. Inventory tightened. Shipping delays became the norm. The CEO himself called it one of the most extraordinary periods the industry has ever experienced. That is not the language of someone who thinks this is over. That is the language of someone preparing for what comes next, because the physical market did not suddenly become balanced. It was only temporarily relieved by the crash. The structural shortage never disappeared. So when prices begin rising again, demand will return, and the same shortages will repeat, only worse. And now the fourth piece ties everything together. The options pressure sitting beneath COMEX. Tens of thousands of silver call options remain in the money heading into the next expiration window. Even after banks engineered one of the most violent silver crashes in decades, the calls survived. That means the slam attempt failed, and every dollar silver recovers brings more contracts back into profit. Here's the danger for the shorts. Each futures contract represents 5,000 ounces. If even a fraction of these call holders exercise and stand for delivery, they are demanding physical silver from a system that does not have enough registered inventory to meet full demand. Most cycles end with cash settlement, but this cycle is different because industrial buyers actually want the metal. When physical silver trades at premiums, delivery becomes profitable, arbitrage becomes real, and suddenly the paper market faces something it cannot print its way out of. So the reveal is simple. Silver is being repriced from the inside out. Governments are building floors. Industrial buyers are paying premiums. Dealers are strained. And futures positioning is creating delivery stress. The paper price you see on a screen is no longer telling the full truth. The real price of silver is emerging in the physical market, where supply is limited, demand is rising, and strategic necessity is taking over. And once that shift becomes undeniable, the move upward will not be slow. It will be historic. Now I want to hear from you, because this is bigger than just charts. This is policy. This is industrial demand. This is supply chain warfare. If the US truly enforces a price floor, if miners continue selling at 30% premiums, if physical shortages return, and if even a fraction of those call holders demand delivery, where does silver go next? 100? 150? $200? Drop your number in the comments. And if you've ever tried ordering physical silver recently, share your experience. Did you face delays, premiums, shortages? The more people understand what's happening behind the scenes, the harder it becomes for the mainstream narrative to hide it. Because this isn't just another rally, this is a structural shift. And here's the part most people still don't realize. These 4 events happened within 24 hours. Government price floors, industrial buyers bypassing COMEX, dealers overwhelmed, options threatening delivery pressure. That kind of alignment doesn't happen by accident. It happens at turning points. The last time silver entered a true repricing cycle, it shocked the world. And now the ingredients are even more extreme. Less inventory, more industrial demand, more geopolitical tension, and now, government-backed intervention. So the next time someone tells you silver is just another metal, remember, you can crash the paper price. You can print contracts, but you cannot print silver, and once the physical market forces the reset, the move won't be small, it will be historic. Stay ready, because the biggest move may still be ahead.